So just to start off with, what is capital budgeting? Capital budgeting is capital budgeting is the process of determining which capital projects, and with that you're thinking about large investments into fixed assets, usually but not always, a firm should invest. So some examples of capital projects for firms. So Evergy, an energy company, you might have more energy producing plants. That would be a good example of what capital project could be for that firm. It could be building new transmission lines and transmission towers. Just the large capital projects for a firm. Mars, the company, not the planet. New production lines or new products. Ford Motor, kind of along the same lines, new production lines, new products, possibly even new production facilities. When they build a new plant for building, vehicles, that would certainly be a capital budgeting project. We'll talk about independent and mutually exclusive projects. So an independent project is just a project we evaluate on its own. A mutually exclusive project, this is a situation where the company has more than one option, but due to either limits on geography, and I'll explain that here in a minute, or limits on non-monetary resources, they're limited to only choosing one out of multiple projects. And as a result of that, when we evaluate for a mutually exclusive project, that means we're evaluating more than one project and we're choosing one of those projects. So kind of the standard example of this is when, let's say, McDonald's or Subway or Walmart wants to put a new location within a geographic area. They might have more than one good location, but they might only be able to choose one. So I'll give you an example. For many years ago, about 20 years ago, Walmart had just a single location in Manhattan, Kansas. It was not a superstore. It was a Walmart that did not have a grocery, which was I lived in Manhattan, Kansas at the time. It was very odd to not have a Walmart supercenter there. And so Walmart realized it's a college town. There's a lot of people here. We need to build a supercenter. Well, they had two options in terms of where to locate that center, either on the east side of town or on the west side of town, but they couldn't choose both. And the reason why they couldn't choose both locations was because they would be cannibalizing the sales from one to the other, and so it wouldn't make sense financially to build both locations, although both were good locations. So they had to choose one of the two locations, and they ended up choosing a location on the east side of town. But that's a very common form of mutually exclusive project. So the steps to making a capital budgeting decision, we're taking everything out of order. The first step is to estimate the cash flows. That's actually what you're going to do next week. You need to assess the riskiness of the cash flows, determine the appropriate cost of capital. That's what we started doing in the previous 2 lessons. Determine the values of the capital budgeting decision tools. That's what we're going to do tonight. And then use the values of the capital budgeting decision tools to determine if a project should be accepted or rejected. So we're going to be discussing the 5 following capital budgeting decision tools: NPV, which stands for net present value; IRR, that stands for internal rate of return; MIR, which is modified internal rate of return; profitability index. I will sometimes abbreviate this as PI. And then the payback period. You may be familiar with some of these, especially NPV, IRR, and payback period. MIRR is an improvement on IRR, and we'll talk a lot about why you may want to consider using MIRR instead of IRR. And profitability index is one I like, and I'll explain why that is later, but it allows us to compare projects of different sizes. So let's say one project has a very large investment and another one has a very much smaller investment. We can still compare those in a meaningful way using the profitability index. First one we're going to start with is net present value. As we go through these, I'm going to use Excel to demonstrate how to calculate them. We're going to use some different cash flows, but you're going to see this set of cash flows a lot in this set of notes. So the net present value is the difference between the current market value of a project and its initial cost. The current market value of the project is calculated as the present value of the project's future expected cash flows, discounted back at the weighted average cost of capital. The NPV is a measure of the value added or net gain in wealth received by taking on a project. And we talked about market efficiency in a previous lesson. The idea here is that if markets are efficient, if the stock market's efficient and a firm takes on a positive net present value capital budgeting project, we should see the stock price of the firm increase based on that information, because the project adds value to the company. So we're going to use the equation is this. It's the sum of the future cash flows of the firm discounted back at the required rate of return. You don't need to memorize this or anything. I'll show you how to work this out in Excel. So the estimated cash flows of the project are as follows, and I have those there. And then the weighted average cost of capital is 9%. So I'm going to switch over to Excel now. And I'm going to put those cash flows in. I'll make these look nice. So our weighted average cost of capital is 9%. So this is what my equation is going to look like in Excel. It's going to be equals NPV. My rate is 9%, and in Excel you would put this in as a decimal, 0.09. Now this is a mistake a lot of people will make, so please don't. Do not include the time 0 cash flow here. Just include the time 1 through times 4 cash flow. And the reason for this is that with the NPV function, that time 0 cash, well, the first cash flow you put in is discounted back 1 year at that weighted average cost of capital. So you're telling Excel that this cash flow, whatever the first one here that you put in here, is going to be discounted back by 1 year. Our time 0 cash flow, though, happens today. So we want to add that in separately. And so your formula should look like this: equals NPV, open parentheses, 0.09, comma, and if you have it set up like mine, E4 through E7, and then close parentheses, and then add in that time zero cash flow. And you'll get a value of $2,145.41. So what this tells us is if our estimates are correct for the cash flows, and if we're using the right weighted average cost of capital, taking on this project is expected to generate $2,145.41 in additional value for the firm. So the decision rules for NPV: if the projects are independent, except if the project NPV is greater than or equal to 0. And I put equal to 0, at least theoretically. Realistically, it would be very strange for you to get an NPV exactly equal to 0. Secondly, you probably wouldn't accept it because you want to show that you're adding value to the firm. And 0 just means that you're earning back the required rate of return. So for example, if you went into a bank and in your mind you thought, I need to earn a 5% a 5% return on a certificate of deposit, and they were offering a CD that earned 5% return, well, you would buy it. It would be a rational thing to do. It gives you the required rate of return that you require, and so it's what you want to do. So that's why, in theory, we should accept that project, because it's going to give back investors their required rate of return. However, first of all, it's very, very, very unlikely you're going to get a $0 NPV. Secondly, these are risky cash flows. Project cash flows do have some risk inherent with them, and we adjust the weighted average cost of capital based on that. However, just a flat 0 NPV, while it does it is expected to give us back our required rate of return, typically we'd want to have some margin of error there for the project, so we don't potentially lose value by taking on the project. And we'll talk more about that when we get into the internal rate of return discussion. If projects are mutually exclusive, accept projects with the highest positive NPV. Those are going to be the ones that add the most value. So that's NPV, and it is pretty straightforward. Greater than 0 is acceptable, typically. Less than 0 destroys value. We don't want to accept it. Internal rate of return. The internal rate of return is the discount rate that forces the present value of inflows to be equal to the initial cash outflow and forces the NPV to be equal to 0. So it is the rate of return that if we use that in lieu of the weighted average cost of capital, then the NPV would be equal to 0. What we're looking for here is that the IRR is greater than or equal to the weighted average cost of capital. And the equal to means that if the weighted average cost of capital is equal to the IRR, that means NPV is equal to 0. So it's kind of along those same lines. We probably would not accept it if the two were equal. However, theoretically, it is earning back the required rate of return. So if the IRR is less than the weighted average cost of capital, the project's return exceeds its cost, and there's some return left over. Oh, sorry. That's wrong. Is greater than the weighted average cost of capital. The project's returns exceeds its cost, and there's some return left over to boost the stockholders' returns. So for an independent project, if the IRR is greater than or equal to the weighted average cost of capital, in theory, we would accept the project. If the IRR is less than the weighted average cost of capital, There we go. Reject the project. For mutually exclusive projects, choose the project that has the highest IRR as long as it is greater than the weighted average cost of capital for the project. So I've got the same example here. I'm going to pull up the spreadsheet. You don't actually need this information. Oh, sorry. Yeah, you don't need this information to determine the weighted average, the IRR of the project. We just use the weighted average cost of capital to compare the returns for the project to the hurdle rate that we're using. So I'll pull that up here. So this is the NPV. The IRR is pretty straightforward. It's just equals IRR. And you highlight all the values in this case, not just the positive cash flows in the future. And it says on here that you can, there we go. It says comma and guess. We're not going to use that guess right now. We use that guess if there's a negative cash flow beyond the year zero cash flow. Because in that case you can have multiple IRRs, and we're going to work through an example of that here in a few minutes. But I put in my equals IRR, open parentheses, highlight all of my cash flows, close parentheses, and then press enter. And for this, you're going to want to go out a few decimal places. So our IRR for this project is 9.62%. That's greater than 9%. And so we're happy with that. That would earn us a return that's greater than what's required by our investors. So it's 9.62%. So sometimes IRR and NPV don't provide the same decision for mutually exclusive projects. And I encourage you at this point to go ahead and hit the pause button and calculate these on your own. That's what I would do if we were meeting live. But I'll go ahead and work through them too. But I like to use that just as a little practice to make sure that you're getting everything okay. So I'll calculate the NPV and the IRR for both of these two projects. I'm going to highlight this. I'm going to copy and paste that over into Excel. Our weighted average cost of capital according to this is 10%. So I'm going to put in here NPV and IRR equals NPV. The rate is 10%. Again, don't include the time zero cash flow. We're going to add that in separately. And we get 2906 for our NPV of project A. And for investment B, we get 2979. The IRR is just equals IRR. We get 24% for the first investment, and we get 21.03% for the second investment. Now, the first thing I want to mention is that both of these projects would be acceptable if they were independent. Okay, they both have an NPV that's positive and relatively high based on the size of your investment. Also, the IRRs are very high. Weighted average cost of capital is 10%. For the first one, you expect to earn a return of 24%. For the second one, you expect to earn a return of 21.03%. But you'll notice that if you had to compare them and you had to pick one of these, that might be a little difficult because you have for investment A, it has a higher internal rate of return, and for investment B, you have a higher NPV. And so you'd have to make a choice here which one you want to go with. And we're going to talk a little bit about how we would make that decision and why we're getting these different answers. I will pull that over to here. Let's see. Here we go. So do the NPV and IRR give the same accept reject decision for the mutually exclusive projects? No, they don't. If not, why not? So I'll tell you the specific reason in this case. It's because the larger cash inflows occur earlier with investment A, and the larger cash inflows occur later with investment B. So what we're going to do now is something called an NPV profile. And what we do with the NPV profiles is we use different weighted average cost of capital to see what the NPVs would be using those different discount rates. So again, what we'll do is we'll go over here. I'm going to copy and paste this into Excel. And we're going to calculate the NPV for each different weighted average cost of capital. So going back to the NPV function, you can see here we have NPV, and then we put in the weighted average cost of capital. In this case, we're just going to reference the left-hand column here for the weighted average cost of capital, and then put in the rest of our equation. So that's what I'll do here. I'm going to put in equals NPV. My rate is going to be what's in that column there. I'm going to go ahead preemptively and lock in the column. So I'm going to drag this over to investment B. And when I do that, this will allow me to maintain the same column there. And then I'm going to put in my values, just like I did before. And again, only including the values after time zero. And then finally my time zero cash flow. And what I want to do here is I want to lock in the rows and not the column. So the first one says the NPV with a 0 weighted average cost of capital, 0% weighted average cost of capital is 60, and we can see that. We can add it up here. So 50 plus 40 plus 40 plus 30 is 160. And then we subtract 100 from that, and it's 60. The reason why we can do that is because we're not discounting these cash flows. And then I'm just going to take this. I'm just going to drag it down. Okay. I'm going to do the same thing. I'm going to pull this over, and hopefully that works right, and it does. And so we can see here what our NPVs would be at different weighted average cost of capital. And feel free to pause the video in case I'm going a little fast there with the Excel. Now I'm going to create a graph to show you what the NPV profiles look like. So I go to Insert and then Charts over here. I'm going to choose the scatter, the scatter chart, and I want to, I'll just put it in like that. So we can see here that they have so the, I guess orange, my monitor's weird here. It's orange or red based on what your monitor looks like. So this line up here is the NPV for project B. And if there's 0 weighted average cost of capital, it's preferred to project A. At 5% weighted average cost of capital, it's preferred to project A. At 10% weighted average cost of capital, it's still preferred to project A. At 15% though, investment A is preferred over investment B. Okay, so it has a higher NPV, and then we see that continue on. This point here, at that place where they cross over, is known as the crossover point. And that's the point at which both the two investments have the same NPV at that weighted average cost of capital, and we would be indifferent between the two projects at that weighted average cost of capital. And again, the reason for this is because of the difference in the timings of the large cash flows for those two investments. I'm going to put this over in our notes. And I'll get rid of this as well. And so that's our NPV profiles. That's not the graph. There we go. And this is, I should have put up here NPV profile where the chart title goes, but I won't do that here. So why do the NPV and IRR results not always agree? Because they didn't here, based on, it was dependent upon what the weighted average cost of capital is. The overall reason, so I gave you a specific reason up here. The overall reason that they don't agree is that there is a difference in the assumptions of the reinvestment rate of the cash flows. So they don't always agree because of the difference in the assumptions of the reinvestment rates of the cash inflows during the life of the project. So let's go back up to these two projects and I'll show you what I mean. So at time one, investment A, the company's going to get $50. And the company's got to do something with that money. They can either pay it out to their investors or they can reinvest it. If they reinvest it, there has to be an assumption made about the rate of return they're going to earn. IRR assumes that you're going to earn the IRR for the project for any future projects that you take on. So what that would mean in this case is that we have, invested in investment A here, we're generating cash flows, and we're going to take that money, we're going to reinvest that money, and according to the calculations for IRR, we're going to reinvest that money at 24%. Okay. NPV doesn't make that assumption. NPV says, okay, we get the $50, we're going to reinvest it, but we're going to reinvest it not at 24%, but at 10%, because that's our weighted average cost of capital. So that's the difference between the two. IRR assumes that cash inflows for a project are reinvested at the IRR of the project. NPV assumes that cash inflows for a project are reinvested at the weighted average cost of capital used for the project or the firm. In this case, we're considering a weighted average cost of capital for the entire firm, although we can have different weighted average cost of capital depending on the riskiness of the project. So which is a better assumption to make? My opinion is that the assumption calling for the use of the weighted average cost of capital is the better choice because it's a more conservative choice. We aren't using the 24% to determine whether or not to accept or reject projects. For this company, we're using 10%. And so the idea being here is that we won't go lower than 10%. Hopefully all of our projects earn really high rates of return, but we can't assume that they will. So for me, I prefer to go with the assumption that the weighted average cost of capital is the correct choice as the reinvestment rate. And then I'm going to show you a way that we can still use IRR here in a little bit, but changing it to use the weighted average cost of capital instead of the IRR as the reinvestment rate. Another problem with IRR is that we can have multiple IRRs. So sometimes non-conventional, and evidently it's not a word, but non-conventional cash flows for a project will provide more than one IRR. So what we have here is a project where we have it looks like a normal project. We make it, we have our cash outflow at the beginning of the project. That's going to pay for whatever capital asset we're purchasing for the project. We have our cash inflows, and I kept this really simple. And then at the end of the project, we have a large cash outflow. This is not considered to be normal. However, it does happen, especially if you're working on a project that at the end of it, you have a large piece of equipment or some land or something that needs to be cleaned up or disposed of in a special way. And so shutting down the project can have a significant cost associated with it. So we've got this project here, and we're going to calculate an NPV profile based on the cash flows we have here. So again, I'm going to pull this over into Excel. So here are our cash flows, negative 17,000, 4 years of 16,000, and then the last year 52,000. If our NPV is equal to zero, or excuse me, our weighted average cost of capital is equal to 0, this is what our NPV is going to look like. I'm going to put in equals NPV. I'm going to put in my rate over here. Notice I'm not locking anything in on this one, but I'm going to lock these cash flows in. I'm going to highlight my cash flows. And then up here, I want to lock those in so they don't change when I drag this down. I'm going to close the parentheses here and then add my, oops, I made a mistake there. There we go. I don't want to include that times 0 cash flow in that. I want to put it out here. And so that's what my, my formula is going to look like. And then I also want to lock in this last cell. So notice all my cash flows are locked in. My discount rate is not, because I want that to change as I drag this down. And so what we see here is that we start off with a negative NPV with a weighted average cost of capital of 0, and then it's positive for a while, and then it's negative again. So I'm going to graph this to show you what it looks like. And it looks like this. So this is my NPV profile, my different NPVs with my different weighted average cost of capital. And we can see here that we have 2 points where the NPV is equal to 0. So one point is right around here. I'm going to say around 7%. I'm not positive about that. And then I have another one out here at about 67%. 66% maybe. And we're gonna double check that here in a minute. But my problem is that I don't know which IRR, because remember the IRR is the rate of return where the NPV is equal to 0. I don't know what the correct IRR is here because I have 2. If my weighted average cost of capital is 10%, then this one would not be acceptable, but this one certainly would be. And what's happening here is that we have that large cash flow at the end. And so, with the 0 weighted average cost of capital, this large cash flow at the end is not discounted enough when the present value is found to overcome the negative value of this relative to all the cash inflows. At 10%, 20, 30, 40, 50, 60%, this last cash flow, this negative cash flow here, is discounted enough so that the overall present value of all the cash flows is positive. And then once we get to really high weighted average cost of capital of 70 and 80%, that reverses. And while the last cash flow is pretty heavily discounted by the time we discount it back to today, the other cash flows are as well. And so the combination of all those don't overcome the negative 17,000 because those are very high weighted average cost of capital. So what I'm going to do here is calculate the IRR for this project. And I'm going to do it once without putting a guess in, and then I'm going to put guesses in, and I'll show you what happens. So this is equal to IRR. I'm going to highlight all my cash flows. And I get, as I mentioned before, about 7%, 6.77%. So that's it right here. Okay. But you'll notice whenever I put in the IRR function, it gives me the option of putting a guess out here. So if I go back to this formula, oops, sorry about that. I'm going to go back out to this formula, and I'm going to put in here a comma, and now I'm going to put in 60%, 0.60, okay, because I have another IRR out here, and I get 65.36%. Because I told it, I told it what I thought the IRR was close to, and I didn't say it was close to 7%, I said it was close to 60%, and so it captured this one instead. So where the line crosses over here is at 65.36%. Now, if you would feel uncomfortable making a decision based on either a 6.77% IRR or a 65.36% IRR, you wouldn't be alone. So now I'm going to go over how we solve that problem. So first of all, why bother with IRR? IRR gives us a measure of the safety margin of the project. In other words, it's very easy to calculate the IRR of a project and compare that to the weighted average cost of capital. Let me give you an example here. If the NPV for a project was $10,000, okay, would you accept it? So normally the answer would be yes. The NPV is greater than zero. We're adding $10,000 of value to our firm. Sure. However, what if the initial investment, that time zero cash flow, was 10, and I think I'm going to put this in right. I'm not quite sure. Say 3 more zeros, $10 quadrillion. Okay, first of all, there's not that much money, but we would normally say no because that's a tiny, tiny, tiny outcome for that much investment. So the IRR in this case would be, in this situation, would be such a tiny amount over the weighted average cost of capital that it would really bring it into question. Several years ago, I met with some folks with the investment advising group at Walmart, and this is what they do there at Walmart. They evaluate capital budgeting projects. And they told me that, and there was like 4 guys, I'm going to say early 30s, they each had their MBAs, and they told me that they had a 4-hour discussion with Rob Walton, who was, and I may still be, the chairperson for Walmart, also one of the wealthiest people in the country. So, they're arguing with the chairperson for their company about this. Rob Walton liked IRR. And for the reason that I told you, it's an easy, quick way to see if you're earning back the required rate of return. They preferred NPV because it doesn't have that assumption that you're reinvesting at the internal rate of return for the project you're looking at. And Walmart does have a lot of mutually exclusive projects. I mentioned one in Manhattan, Kansas before. And so this was, again, something they had a long discussion about with Rob Walton. And of course, Rob Walton gets his way because he is the chairperson. But it is something that comes up. It is something that is important. So we have an alternative that improves upon the problems, it corrects the problems with internal rate of return. It's called the modified internal rate of return. I've got a whole bunch of equations here. I'm going to work out an example for you, but I want you, we can actually calculate it pretty easily in Excel. So the modified internal rate of return allows the analyst to determine the reinvestment rate for the cash inflows for the firm, or the reinvestment rate for the cash inflows of the project that you're looking at. In other words, you don't have to say it's going to earn back the internal rate of return for the project. You can choose a different reinvestment rate. In our examples, we're going to use as a reinvestment rate the weighted average cost of capital, because we know that's our hurdle rate, and we know that our investments are, at least in the near future, are going to have to, at a minimum, earn back that rate of return. So that's what these equations show. COF stands for cash outflows. Those are going to be your negative cash flows during the life of the project. So in our previous example here, the cash outflows would have been the $17,000 at time 0, and then the $52,000 at year 5. Our cash inflows as CIF are the positive inflows. So in this case, it would have been these 4 $16,000 inflows. And so our WACC is our weighted average cost of capital, and then MIRR is what we're solving for eventually using this formula. So let me go ahead and show you, using this example, what that looks like. I'm going to show you kind of the longhand. I won't ask you to replicate this, but I do this so that you can see what's happening when we do this calculation, and then I'll show you how to do it very easily in Excel. So I'm going to go back to Excel here, using these cash flows. So I'm going to find the present value of the cash outflows. So what that's going to look like here is I'm going to take the present value, the rate, so equals PV, open parentheses, rate is going to be our 10%, our 0.10. Our number of periods is 5. Our payment is 0, and we're just going to find the present value of that $52,000 at the end of the time period. So if we find the present value of that, it's $32,287.91, and you can see that's a positive number. We're going to go ahead and make that negative. And then we're going to subtract out, or kind of add to, that the $17,000 today. We're not finding the present value of that because we don't want to discount it because it's a cash flow occurring today. Okay, and that's not right. Let's try. Oh, I should have added it because it's already a negative number. There we go. We're going to add that in there. And so we get $49,287.91. That's the present value of the cash outflows discounted back to today at 10%. Now we're going to find the terminal value, or the we're going to find the future value, the terminal value of the cash inflows, and our reinvestment rate's also going to be 10%. And to do that, I'm going to find the future value of each one of these cash flows in 5 years. So what I'm going to do here is I'm going to put in equals future value. The rate is our 10%. That's what we're going to say we're going to reinvest our cash inflows at, is at 10%. The number of periods in this case is going to be 5 minus whatever number is here in the year. So what that means is that we earn this cash flow in year one at the end of year one, and then we reinvest it for 4 years at 10% until the end of our project. Our payment is 0, and then our present value is at 16,000. And I want to make this, I'm going to change the sign here, because what will happen if I don't is that I'll get a negative number, and I want a positive number for this. So if we took that $16,000 and we received it and we reinvested it at 10% per year for the next 4 years through the end of the 5th year, we would end up with $23,425.60 at the end of that 5th year. So now I'm just going to take this and I'm going to drag it down through those 4. And just as a little check here, we have $17,600 as our future value 1 year later after reinvesting it at 10%, and that's correct. So 10% of 16,000 is 1,600. So 17,600 is 16,000 plus 1,600. So I'm going to find the sum of these 4 numbers here. Sorry. All right, and we get 81,681.60 cents. So I want to find the rate of return, the annual rate of return that causes this 81,681.60 to be discounted back to this 49,287.91. So I'm going to put in rate. The number of periods is 5. The payment is 0. The present value is our 49,287.91, and the future value is our 81,681.60. Type doesn't matter here. If we're using payments and this was an annuity due, we would put in 1. If it's just a regular annuity, we'd put in 0. In this case, we're not going to put in anything. And then we'd also put in a guess, because this is a rate. If we felt that there was more than one possible answer here, then we would put in a number for that. But we don't need to do that in this case, so I'm just going to shut it off at that future value number. And I get an answer here of 10.63%. Now you don't need to do all that in order to determine the MIRR. I just wanted to show you mechanically what's going on. You just need to put in equals MIRR, highlight all of the values, and then it says finance rate and reinvestment rate. So the finance rate is the weighted average cost of capital. It's your cost of financing. We're going to use 0.10 for that. And then our reinvestment rate, this can be any number you feel is accurate. We're going to use the weighted average cost of capital in our examples and what we do in this class. So I'm going to put in 10% again there, and I get 10.63%. Okay. So again, it's pretty easy. Just put in equals MIRR, put in your finance rate, put in your reinvestment rate. And for both of those, use the weighted average cost of capital, and you'll get that modified internal rate of return. Going back to the notes then, if my answer, well, so for up here, we have a MIRR of 10.63% for this example here. If I go back, go way back to these 2 projects now, I'm going to do the same thing. I'm going to put in equals MIRR, and we're going to see what happens. Okay. In this case, double check to see if I have a So I don't give you weighted, oh, wait a second, I do. The weighted average cost of capital is 10%, so that's what we're going to use here. And then I'm going to put in 10% for my finance rate and my reinvestment rate. And I get a modified internal rate of return of 17.24% for investment A. And I get 17.41% for investment B. So now, if we don't pay attention to our IRR, instead use our MIRR, we get consistency between NPV and MIRR for choosing which investment. So if we look again here, investment A has the lower NPV and the lower MIRR compared to investment B, which has the higher NPV and MIRR. So our choice in this case should be investment B. So now I'll scroll down past all that stuff. So that is the modified internal rate of return, and it can be used to correct the problems of IRR, namely the problems with multiple IRRs due to negative cash flows after the time zero or year zero cash flow, and also it corrects the problem in general with the issue concerning the assumptions about reinvestment rates. Next, we're going to move on to the profitability index. And this is one you may not have seen before or may not be familiar with. I really like it because what it allows us to do is that it allows us to compare projects of different sizes, or different initial investments. So if you have, you're looking at two potential projects, and one project is going to cost a lot more up front than another project. This allows us to take that into account. It allows us to scale the outcomes of the project in a meaningful way so that we can truly compare them. It shows us the bang for the buck for the project. So in other words, it shows us what the return is going to be in dollars relative to the initial investment. It's pretty straightforward. It can be calculated as the present value of future invested cash flows divided by the initial cost, or another way to calculate it, and kind of I think a more common way, is that we would actually take the sorry, I got a little ahead of myself there. 1 plus the NPV of the project divided by the initial cost. Okay. So if you already have NPV calculated for the project, it's really straightforward. Divide that by the initial cost and add 1 to it, and you have your profitability index. So going back to our original example, I'll go out here on Excel to show you this example. Go. So we're going to go back here. This is our original example up here. So 2 ways to calculate it. The first way is the one I have there, which is the present value of the future cash flows divided by the initial investment. So this is going to be, put in PI for profitability index, is equal to the present value, the NPV of the future cash flows. So our rate's going to be our 9% in this case from our original example. I'm going to find the present value of these cash flows. Here we go. And then I'm going to divide that, and I want to make this number positive, otherwise I'll get a negative number here, which wouldn't make a whole lot of sense. So that's our initial cost is $150,000. So this is our profitability index, and it's just a number, it's not a dollar amount, so is 1.01. The alternative method is that since we've already calculated the NPV here, I can just put an equals 1 plus my NPV here divided by, and again I want to make this denominator positive by putting a negative sign in front of it, and I get the same answer, 1.01. So what that tells us is that for every dollar we're investing, we're getting $1.01 back in, and actually it's a little bit more than that, but we're getting a little bit more back when we invest. So it's 1.014. So what that means, although it's not much higher than 1, it means that it's an acceptable project because we're getting more than the dollar we put in back. If the NPV is equal to 0, then the profitability index is just equal to 1. So the profitability index of the project is 1.014. The decision criteria for independent projects: if the PI is greater than or equal to 1, for mutually exclusive projects, the higher the better. If NPV is equal to 0, just as I just mentioned, the PI is equal to 1. If the NPV is negative, then the PI is less than 1. So it doesn't necessarily have to be negative. And if NPV is positive, then PI is greater than 1. So again, what this allows us to do is to compare projects of different sizes because we're dividing the NPV by the initial cost. So if we have one project that has twice the initial cost as another project, we might get a much higher NPV, and hopefully we would get a higher NPV for a project that costs a lot more. But just comparing NPVs in that case wouldn't be correct because we're also investing a lot more for that other project. And so we'd want to use something like the profitability index in combination with modified internal rate of return to evaluate those two projects. The last rule we're going to talk about, or the last measure we're going to talk about, is the payback rule. The payback rule is the granddaddy of all capital budgeting decision-making tools. You might notice with all of the other ones we've talked about, there's been a discount rate. So NPV, IRR, MIRR, profitability index, we're all using a discount rate. We're all using, they all use a time value of money measure. And those are a little bit more sophisticated than people could really do. Most people could do, think about 80 years ago. At that time in the 1940s, most people didn't use NPV or IRR or MIR. Well, certainly not MIRR. It's a lot newer than that. But they didn't use these because they didn't have the tools, the ability to easily calculate those outcomes. And so the payback rule was a very common measure to use back then, where it was pretty straightforward. You put a time limit on how long it would take for the project to pay back its initial investment. So the payback is the length of time it takes to recover the initial investment from a project with the cash inflows from a project. So to calculate the payback period, there's no magic equation here. You just have to calculate it. One note, assume that cash inflows occur evenly throughout the year. Now, if you have monthly cash expectations and estimates for your project, you can certainly use that. But if you don't, and in this class, we will assume that our cash is occurring or coming in evenly throughout the year. So we're going to literally add back cash flows until we get to the last year and when the cash flows for the year will pay off the investment. So just going off of this, I'm going to start with negative $150,000, or I'll just put $150,000 here. And we're going to subtract out $40,000 in year one. And so our remaining amount to pay back after year one is going to be $110,000. I'll just put out here year one. And then the next year we're going to subtract out $45,000 because that's how much we expect to receive. And what's remaining after that is going to be $65,000. So that's year two. And then in year three, we're going to pay back $50,000. And what we'll have remaining there is $15,000. So at the end of year three, we paid back all but $15,000. And in year four, we expect to receive cash flows of $55,000. So we know it's going to be paid off before the end of year four. So that's where this little note comes in. We're going to assume that cash inflows occur evenly throughout the year. So we know we're going to pay this project off sometime in year four. So what I'm going to do here to figure out the portion of the year is to take what's left over at the end of year three and divide that by my cash, my year four cash flow. And this is equal to 0.2727 and continuing out, but we'll just stop it there. So my payback period is equal to 3 years plus this portion of the year, or 3.2727 years. There's no magic in any of those numbers. You can have a project that pays after 6 years, 4 years, 5 years. You can have projects that never pay back, and of course we would not want to accept those. But in general, the rule is that it's up to whoever's making that decision how long a project should take to pay back. I know a large manufacturing company here in town that is privately owned. I had a student that made these decisions for some of their product lines, and she told the class that their goal was a 3-year payback period, which by the way is pretty aggressive. That indicates a very high return on any of their investments. But it's up to the people making the decision on what the payback rule is for the project. The one big important thing about this method, and really why it has come back in favor somewhat, is that it measures the liquidity of a project. If you remember back when we talked about liquidity, it's our ability to get cash back quickly from the sale of an asset, and that cash or the amount that we get is close to its true value. Well, so this is measuring how fast we get cash back out of a project. So it's a measure of the liquidity of a project. And back during the financial crisis in 2008 and 2009, consultants were recommending companies to go back to this measure because they didn't have access, their access to external capital wasn't as good. Many banks back in that period, your local commercial banks, didn't have money to lend out due to the problems with bad loans. So they had a lot more bad loans on their books. Not necessarily their fault, but just the situation at hand was the real estate crisis, and really if they had excuse me, if they had a lot of real estate loans in their portfolio, regulators would often require them to reserve more funds against those loans, and so they didn't have money to pay out or to lend out to people. And so as a result, companies had to start paying more attention how fast they got cash back out of a project, because if they weren't getting cash back fast enough, they wouldn't have money they needed to operate and to invest in new things. And so they needed to start paying attention to this number, to the payback period. There's some problems with the payback period. It doesn't assign a discount rate to the cash flow. So since no discount rate is applied to future cash flows, a dollar of cash inflow received 5 years from now is treated as having the same value as a dollar today. Now, there is a method of the payback period that I used to teach called the discounted payback period, where you would take the weighted average cost of capital and you would discount the cash flow for each year by that rate back to today, and then use those values to calculate the payback period. Generally, what I found is it's not terribly useful, because it essentially is, in the end, it is calculating the NPV of the project, because if by the end of the project, if the NPV isn't positive, then you're not paying back the project. If the NPV is positive, then you pay it back before the end of the project. So I didn't find it to be terribly useful, and it's rarely used. The second problem is that the payback period ignores cash flows that occur after the date or the pre-specified number of years of the project. So the payback rule ignores cash flows that occur after the end of the pre-specified period. And so if you have a big positive or negative cash flow that occurs after that period, that's not going to be taken into account by using this rule. And so this is another reason why it's important to use more than one measure to determine if a project should be accepted.